Hey, good morning, everybody, and welcome to this Tuesday, April 30th, 2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so, possibly a little bit shorter today as I'm battling some kind of a cold. So I don't know how long my voice will hold up, but we'll at least take a look at some of the charts and see what happened yesterday and kind of move on from there. But just so I don't waste a whole lot of time, let's just go ahead and jump right in to what happened yesterday. Larger so everybody can kind of see as we move from chart to chart. So yesterday we had a positive day across most of the market. Dow Jones Industrial Average finished up 146 points. That was a little bit more than a third of 1%. S&P 500, you can see battling 50-day moving average. That was up to 5116, which was up 16 points, or about 1/3 of 1%. Nasdaq gained almost the same, a little bit more than 1/3 of 1%, back up above its 20-day moving average. But you can kind of see on the Nasdaq, and if you look across some of these other indices, the prior lows, if you recall, when we were going sideways, we kept holding on to support. You can see this support right in here on the Nasdaq, which was about 17.7, 17.8. Notice where we finished at yesterday, 17,782. So after dropping down below 17,000, we made our way all the way back up to test price resistance. And I saw futures were actually down this morning. I can give you those numbers. We got the diamonds, which tracks the Dow Jones, down 0.45%. The Spider down 0.4 of 1%. The QQQ down about 0.45% as well. And then the IWM getting hit the hardest, down a little over 1%, 1.05%. The big thing today is the employment cost index was out this morning, and it showed that the quarter-over-quarter inflationary percentage, if you will, jumped from an expected 0.9% to 1.2%. And so as a result, we saw the 10-year Treasury Yield move up. So there was a lot of selling early on today in bonds. The 10-year Treasury Yield I'll look at in just a couple minutes, but it's back up into the 465, 466 range. Mid caps up about 0.6 of 1% yesterday, also moving up above the 20-day. But again, that prior low on the way up, we had a prior low just above the 2,900 level. Then we broke out again. When we went down, went through that 2,900 level, and now coming back up to test it. So this is a key area of resistance on the mid caps. The small caps up about 0.8 of 1%. So having a pretty good day, back above the 20-day. But again, you know, we were kind of watching that 199 to about 202 area on the way down. Well, we got back up to 200 yesterday, 199.96, and now we see futures are down. So I think this next move, if we do go to the downside, I think this next move will probably tell us a lot about maybe what to expect over the next few weeks to maybe even a month or two. Because if we go back down and we see a lot of the aggressive areas being sold off, and we get that VIX to move back up above 20, that would be, you know, more problematic. But I don't want to jump ahead. Let's see how today goes. But at least at the open, it looks like it's going to be weak. Transports jumped about 43 points. That was up just less than just less than 0.3 of 1%. And again, look at that triple bottom right there at about 15.4 on the transportation index. When we went back up, we got just slightly above it, but couldn't get through the 20-day. And so now we've got the 20-day down at 15.4, and we've got this price resistance up around 15.5, which was from the recent high. So I don't see transportations really improving technically until we can get back through 15.5. From a sector perspective, we had discretionary stocks jump pretty strongly. A big part of the XLY is Tesla. Tesla had a big day. I think Amazon also had a good day. And those are the two big components within the XLY. So that's why you're seeing that big jump there. So it was nice to get back up above the 50-day moving average, but just keep in mind a lot of it had to do with Amazon and Tesla. Utilities making another push to the upside, now back above 67 and the highest level we've seen in 2024. So XLU continues to perform very well. Communication, and I should mention though, with interest rates going back up today, we'll see what happens with the XLU. It might take a little bit on the chin as a result of higher yields. Communication services, the XLC, big gap down there, and then nice rally since then, coming back up again, challenging overhead resistance in the form of those moving averages. Can we get through? That's a big question. Moving on to the industry groups, there's the autos. So you can see that big jump in autos, very similar looking to Tesla, at least the overall pattern of going down and now reversing back to the upside looks very similar to the Tesla chart. Non-ferrous, and by the way, autos up over 12% yesterday. It was a big move. Non-ferrous metals gaining almost 4%, jumping 25 points to a new high. Now, word of caution, it's breaking out, has a negative divergence, but we've talked about it. We just had a session on divergences not that long ago. Hopefully you made it to that event. But divergences, yes, technically, if you looked at the textbook definition, higher high, lower PPO, that's a negative divergence. But this PPO is just starting to turn higher. We don't know on this breakout how far we're going to go. A lot of traders make the mistake of saying, oh, this is slowing momentum. Look at this. We got higher prices and lower PPO. Not the way it works. First of all, there's nothing more important in the market than price and volume. We have a price breakout, number one. That's bullish. Look at the volume that accompanied that breakout. 2.5 billion shares. That's a huge volume level for the non-ferrous metals group. So we had very heavy volume and a price breakout. How do you argue slowing momentum? Makes no sense. Doesn't make common sense. So yes, technically the textbook definition is negative divergence, which means slowing price momentum. But we're getting a breakout with heavy volume. Nothing is more important than that. So I don't buy into the whole, oh, we got a negative divergence, let's short it. We need to see what's going on. Now, if we go up for the next day or two and we see that PPO rise but stay below, and all of a sudden you see a really big reversing candle, like a bearish engulfing candle, if I see a negative divergence with that kind of a price and price action and heavy volume reversal with a negative divergence, that combination can be lethal. So that's what I look for when I see these breakouts and negative divergence, but then with the heavy volume. I'm still thinking bullishly on this breakout until the market shows me something that confirms a top. And that would be like a reversing candle. Computer hardware up 205 points. That was more than 2.3%. Apple had a nice day. This chart looks a lot like Apple's chart. So can we sustain a move? We really need to get back up through this double top, which is up at around 91.25. Until that happens, I would treat this as nothing more than a rebound. Now, if we get back through that level, to me, it's probably going to start looking more like an uptrend. Big difference. So it's looking better anytime you're moving higher, even in a downtrend. That's better than the alternative. But it doesn't mean that we've broken out or that we've changed the character of this chart yet. So encouraging, but still got some things we need to accomplish here before the chart really starts to look to me like it's in an uptrend. All right, voice is already rough, so probably not going to get a whole lot in this session. Maybe I'll try to go another 10 minutes or so. 10-year Treasury yield, let's get the update there. But with that employment cost index out this morning, you can see us jumping 4.67%. We're now up almost 6 basis points. That was after a drop the past 2 sessions. Anytime we get that rate going up, it spooks stock traders. Many of our major indices struggle, especially the IWM, which is showing much worse pre-market activity right now. So let's watch that 10-year Treasury yield. I think a breakout would be bad for the stock market. I don't know. We'll just have to wait and see what goes on there. I'll also be watching the VIX. So if we just take a quick look at the VIX, you can see it's been a huge drop. And by the way, I never saw 21 on the VIX. Intraday, it never went above about 19.5. So I don't know why it's showing an open here, but I would be drawing the open right about 19.5. So we never got it over 20. We certainly never had a close over 20. And we have been going straight down. And usually, remember the end of October when we had, market in that correction mode, went down, set that low on October 27th. At the same time, we had the VIX, which was up above 20. Well, after that top, look at what happened with the VIX. It was just a massive move back to the downside. Looks kind of familiar with what we've seen here. So if we get a gap down, but then we see buying and we see the VIX again down today, it's not going to give a good look for the bears. You really want that fear to be picking up if you're on the bearish side. So again, you've got a bearish report. We've got the Fed meeting. The FOMC meeting started this morning, and we'll get another announcement out tomorrow at 2 p.m. Anything goes, of course, especially with this Fed. I don't know from one meeting to the next what they're going to say. I mean, honestly, we've been all over the place. Everyone can interpret it the way they like. I'm not a big fan of this Fed. They seem to be lacking in transparency, which is what Bernanke started and was one thing I think the market had a lot of confidence in, is knowing what the Fed was going to do or what they're thinking. This Fed seems like every other month things are changing. And I understand, went through a difficult period with the pandemic. I understand we've had this inflation that took off. Looks like it's coming back down. We've had a couple of other inflationary reports that are coming in a little higher than expected, including the employment cost index this morning. I get all that, but the way the Fed flip-flops, I mean, I think that they could have been, instead of talking about how many rate cuts we were going to get, they should have just said we're going to remain data dependent and not given anything, rather than, well, it's going to be, 2 rate cuts, then it's going to be 4 rate cuts, then it's going to be 3 rate cuts. Then you had the Fed recently, all the pawns in the Fed going out and talking, saying we might not have any rate cuts. And I don't want to talk about it anymore. But well, let's see what the Fed has to say. That'll be tomorrow at 2 p.m. Market could go anywhere. Honestly, I don't know what the Fed's going to say. So if they come out and they talk a little bit more dovishly this time, I think you'll see the market explode to the upside. If they take the tone of we don't see 2 rate cuts anymore, 1 at the most and maybe none, if that's the way they go, I could see another pullback, another move back down near recent lows. So at that point, I will be watching some clues like the VIX. If we start heading back down and the VIX goes back up to say 16 or 17, and we're back at the lows and the VIX is nowhere near its highs, that to me is going to be a positive sign. It's telling us that some of the fear, the bearish sentiment is coming out of the market, even though prices have gone back down to a low. And that can be a very bullish sign. But if that VIX shoots right back up, clears 20, we got a whole different animal. Never mind. We can go into the S&P here. You can see the S&P. I talked about it earlier, trying to get through the moving averages. Still not done yet. Same thing with the Nasdaq 100, trying to get through. Got work to do. IWM, I think, probably is the one that is going to be worth watching, because with the gap down today, I mean, I don't know if you've noticed, but look at the last 7 days. 6 of them are hollow candles. Most of them, we are finishing at the midpoint of the day or higher. So I'm seeing a lot of the same stuff that we saw back in here before we made the last push to the upside in the IWM. So it looks like accumulation to me has started to come back in to the IWM. What happens after our gap down this morning? Because it does look like we're going to gap down. IWM typically gaps down more than the others. That's what we've been growing accustomed to. The question is, do we rally back like we've been rallying, or do we see an actual day of distribution? Remains to be seen. Something to watch for. Transports, again, talked about them earlier, really need to get through about 15.5 now before I'm going to start to grow more comfortable here. In the meantime, we've taken out the 15.2 low. We do not want to go back down and take out this recent low. If you go down, break down below prior support, rally back, fail at the 20-day, and then break to a new low, that is a pretty good sign of a downtrend that's in play. And as I look lower, I mean, I see the gap support here just below 14.6, but really the main support is all the way down at about 13.6. And I don't need to tell you, 10% drop in transports from where we are now down to 13.6 would not be a good look on the transports and probably would not be good for the market. So this is a group that I think we need to watch closely as well. All right. If you're a fan of earnings beats, if you like the way we approach the market, I'd recommend you go over to earningsbeats.com. You can start a free 30-day no-cost trial. We'd love to have you there. Or just scroll down and we've got an area where you can sign up for our free newsletter. No credit card required. Comes out 3 times a week. Name and email address, all you need there. Hit that subscribe button. We'd love to have you. Anyway, let's move on. The chart I wanted to show today is Super Micro. And the reason I'm featuring this one, they report after the bell today. And quite honestly, I'm not sure which way it's going to go. I think they're going to have a good report. I can't believe they're going to have just a massive report last quarter. Then all of a sudden, you know, the demand for their product's just going to dry up. I doubt that's happening. But it's also run a lot since earnings. And so sometimes after you run a lot, you go through a period of consolidation. And we've, I think, established a pretty important low right here at about 700. Clearly, we have a high established at 1,200. We're sitting at 890. I didn't look at the stock. I can tell you pre-market what's going on. It's down $10 to 880. I could see the stock back at 1,200 after they report earnings. I could also see it back down to 700 level. And that's a wide margin. And, you know, if you're going to hold a stock like this into earnings, you have to be willing to take on a lot of risk. Think about position size. I mean, if you're into a stock like this and it's one of your heavy holdings, you know, it would be obviously jumping back to 1,200 would be amazing. But think about the flip side, the possibility, even if they come out with good numbers, the possibility that this sideways consolidation continues. And maybe it's not, even though it's a good number, maybe it's not as good as Wall Street's expecting. And so we could easily see 700. So just keep that in mind. I do not own, or I'm not holding SMCI into its earnings report. It could go either way, really up to you. But I would really think about position sizing because you can make money, make some good money without having a whole lot of shares of the stock. And that at least kind of buffers the blow to the downside a little bit if you have fewer shares. All right, I think the last thing I'm going to talk about, this is the upcoming earnings chart list that we do every day during earnings season. This has all the companies that reported yesterday after the bell or this morning before the bell. That's the way we set these chart lists up. So every company that's on this list has new news going into today's opening bell. And we can sort it a number of different ways. The way we number this is if it starts with a zero, it reported yesterday after the bell. If it starts with a 1, it reported this morning before the bell. If it's, and then the numbering after those, you know, either the 0 or the 1 tells you the market cap. It's ranked in order of market cap. So if I sort this by name, you'll see that NXPI was the largest company that was reporting last night. And it's in the semiconductor space. They had a good reaction last night. Let's see what's going on. Stock's still up 4% this morning. 257. It looks like it's below the key level of resistance. Now, you know, we're going to open in 10 minutes. But what I would be watching for, let's see, 257.33 is the open there. 257.76. So here is your highest candle body. Open 257.76. And right now, NXPI is trading at 257.29. I'll be watching to see whether it opens above or below that 257.76. If it opens below it and then trades above it, if it comes back down and goes below the open, personally, I think that could be a shorting opportunity for a day trade. When I see a stock gap up but fail to make a breakout on the open, and then go up intraday and then reversing, start to come back down. Keep in mind, you got market makers on the other sides. Anytime you get those big gap ups, you get a good report, everybody wants to buy. So you got a lot of demand. Market makers provide liquidity. They're on the other side of the trade. They're shorting. Who do you want to be? Who do you want to follow? The traders that chase or the market makers that make money all the time? I mean, if I'm going to have a choice, it's going to be on the market maker side. That's why a lot of gaps fill their gap in the first place. But I think one key sign of where this stock finishes today is whether it opens above or below 257.76. Just watch it. I mean, it doesn't happen every time. Nothing does. But in my years of following the market, and especially earnings, because that's primarily what I like to do. I like to trade gaps. Watch to see whether it opens above or below 257.76 today, and then see what happens the rest of the day. And do that with a number of stocks, not just this one. But when you see stocks that gap up or down near resistance or support, check that out. Check to see what happens when they open above or below key levels. I think it's really important. Let's go back. So that's NXPI, but you can see the list of companies that reported yesterday. MicroStragety, another crazy volatile stock. This morning, they're showing they're down $86, down 6 2/3%. So this one looks like potentially, well, let's pull that one up as well, because this is one going in the other direction. And what I'm showing is recent lows being down at about 1174. So MicroStragy looks like it's going to open above support. So if it opens above support, goes back down below support, and then starts to reverse back to the upside, that's a possibility on the long side. Now, I have not looked yet to see whether these companies beat revenue, consensus estimates, or their earnings per share consensus estimates. If a stock is beaten both, that's normally going to be kind of a green light for me to go long if I like what's going on in the chart. If the results are mixed, then normally I won't trade the stock. I just watch it and see what happens and see how it plays out. Anyway, just a couple of minor tips there. All right, it's almost 9:25. I made it 25 minutes. I don't think I can take it any longer. Hope everybody has a great day. And till next time, happy trading.